Hi, this is Jim Cunningham, and I have with me today Christina Lindsay. And what we're going to talk about is what to expect after the election with the makeup of Congress, the Senate, and the White House. We are just coming off of the 2024 presidential election. We are in sort of mid November, and we're trying to help people navigate what has happened in the past, what is likely to happen in the future. And it's a hot topic. I know I'm personally concerned about this. I think if you're watching this, you are as well. I think anybody would be concerned about it. But how does the composition of the Congress, Senate, and the White House impact the financial markets? And in the news today, I was in Christina. When I get up, I look at the news right on my phone. There's no newspaper anymore, but I did see it looks like the Republicans will have sort of the trifecta of obviously the White House, the Senate, and now it looks like the House of Representatives, albeit a thin majority. So this is
Correct.
highly relevant
And it
in
was just called earlier this morning by Associated Press and Wall Street Journal. So it's
right.
confirmed there's a trifecta, but to your point, a slim majority in the House.
Yeah, so it only takes a couple of Republicans to say, "Yeah, I don't like what you're doing," and they're not going to get a bill passed. So that's really important to understand. You have literally a couple of hundred people to make a little over 100, couple hundred people to make a majority. It's 1% of the people can say, "No, I don't like that," and you're not going to get your bill passed. I'm Jim Cunningham. I'm an attorney. I've been an attorney for 30 years. We have office. I'm a partner at Cunningham Legal offices throughout California. I'm a certified specialist in estate planning, trust, and probate law, real estate broker, securities, insurance licensed, and a pilot single engine land. These are the lawyers at our firm. For those of you watching, they keep more faces keep appearing here. It's a great group of people, and we just love helping people with all things estate planning, real estate, corporate, and with you, Christina, financial services. So this is what you offer is three certified financial planners at Ascent Wealth Management, a great team, and help out a lot of our clients, help out a lot of other law firms' clients, and you just are doing a great job. And it's a pleasure to be doing this video with you. Disclaimer here: I'm a lawyer. I'm going to be saying not a whole lot of bunch of stuff this time. I might caution you, Christine, if you throw out an acronym, I might give you the I to explain what it is. But anything I say is not legal advice. Obviously, I'm a lawyer, and I'm talking. This should not be taken as legal advice. And why don't you have your disclosure as well?
And then this is our disclosure. We are registered with the SEC and FINRA. We have both an RIA, which is Cooper McManus, and our broker dealer, which is Cambridge Investment Research. We give investment advice on an individualized basis, have to make sure that it's in the best interest of the client as we are fiduciaries. We're certified financial planners as well, as Jim had mentioned. So none of this that we're speaking of is investment advice or should be deemed as investment advice.
And our law firm has offices throughout Northern and Southern California, so within driving distance of a good chunk of the population. And let's talk about, Christina, S&P 500 index returns. What is the S&P 500? What does that mean? Let's just lead with that. What are we talking about? What is this?
Yeah, the S&P 500, it's interesting because that's probably the most widely tracked index benchmark for large cap US domestic equity companies. And I think we grew up kind of in the era of watching the Dow. And I still have a lot of clients that watch the Dow and go, oh my gosh, it fell or it dropped. Like right now, it's dropped 160 points for today. That's 0.3%. So the Dow, at 160 points when the Dow was 10,000, 15,000 was a big deal. But now that we have the Dow at, 44,000 practically, this is not a big movement. So S&P 500 is actually tracked a little bit more closely in the industry, and that's your large cap stocks.
What does a large cap stock mean?
It's a large mega company that has, typically over, I don't know what the threshold exactly is now because it's always a moving target, but you're going to have over about $25 billion of revenue. So a large company, not like a small or mid-sized company that has under 10 billion of annual revenue. You're looking at a larger corporation.
Great. And I think it's something, one of the nice things about an index and looking at it is everyone agree on what it is because it is defined at a certain point in time. Now, the S&P 500 that exists today was not the S&P 500 10 years ago, right? They're
Correct.
swapping stocks out. So that's really important to understand is it changes over time, that the composition of the S&P 500 does change. But let's talk about what you got here on the slide.
Yeah, so a couple of these slides, I just threw a couple in here that were from our webinar that we did leading up to the election, of kind of going over some of the angst that people have. And I think that it's important to remind people that the election years, presidential election years, tend to end positive, with the exception really in recent history of being '08 and following the dot-com era. So you had very few exceptions to a positive election year, which we're seeing no signs of any different this year, that we're going to finish the election year in the positive territory. So a couple of these slides are just, good reminders, and then we're going to dive into some new data and kind of what the expectation is with the outcome of the election being in complete Republican control. So we wanted to just kind of go through a few things. Because we're in this 3 months post, election, what we do tend to see is, as Jim mentioned at the very beginning, it tends to be a bump that's to the positive, regardless of outcome of the election as to who wins, whether it be a Democrat or a Republican presidential win. You do tend to see a little bit more liftoff when there is a Republican win, which we've seen. I think we saw that immediately following the election and the days post-election after Trump was announced that he won. We did see a pretty decent run-up. The most important thing is that the markets love certainty. And so we've seen exactly this start to happen. And so this is what we normally see post-election.
It's interesting because people, like in the estate planning context, people will say, well, I want to wait until after the election before I set up my living trust. And I'm thinking, what? Or
I
people,
know.
I'm going to wait to paint my house until after the election. I think it's because our mind is focused on the election, right? It's
We
like,
had a lot of people, say, well, I've got cash on the sidelines. I just want to wait till after the election. And it's funny. And that's really where I think the biggest downside to humans in general is making emotional decisions. And when it comes to your financial portfolio, it should be more disciplined. It should have more, fundamental logic behind it, and really go back to your needs and your goals. And so timing the market is always just a fool's errand if we're trying to actually specifically time the market. But the underlying trend is upward post-election. The markets finally have certainty, and that's what we're seeing is in the post-election results.
so let me ask you, what do you mean by timing the market, which is kind of obvious, I think, to a lot of people listening? What's the opposite of timing the market? So if you say don't time the market, but you have, you're retiring and you've got money to invest, or you've got, you have an inheritance of 500,000, or how does timing the market play into that? You know what I'm saying?
Yeah, I mean, I think that there's several different approaches. There's the old school, completely just buy and hold, set it, forget it, and not suggesting that is the way to go. I think just taking a disciplined, systematic approach to getting money that's on the sidelines systematically invested, much like you would if you've got a 401k contributing on a monthly basis. Your dollar cost averaging into the market. If you're taking distributions, your dollar cost averaging out of the market, so that you're not catching any one particular day of major swings. So there's some philosophy there. There's some systemizing a little bit of how you're going into the market. So there's a difference between buy and hold and make tweaks versus, okay, I've got all of this on the sidelines and I'm trying to specifically time exactly when it's all going into the market. You gotta be right twice when you're trying to be that precise on putting money in or pulling money out. You got to know when to get in, you got to know when to get out, versus, okay, this is what my portfolio needs. This is what my goals are. This is how I'm systematically going to go about it. I'm going to make tweaks along the way versus just buy, hold, set, and forget. But I'm not trying to wholesale make changes based on market conditions. S&P 500. So this is kind of to that point too, from the 3 months post-election. This is another way of looking at this, is from inauguration day to election day. And I actually got a chance to look at some of the underlying data that went into this and the actual spreadsheets that kind of go, okay, this is truly like what the S&P 500 index value was on election day, what it was on inauguration day. And the average return when you're not in a recessionary environment is 5.9% to the upside. So this just goes back to, again, the markets are kind of breathing a sigh of relief, regardless of whether your personal outcome of what you wanted from the election. The markets are breathing a sigh of relief of, okay, we've got certainty. We know what we're probably dealing with. We can move on. And so, and if the expectation is taxes to come down, which we're going to dig into some of this detail, but if the expectation is corporate taxes come down, interest debt servicing rates are starting to come down, then you're going to have greater earnings for corporations. And at the end of the day, politics aside, the stock market is driven by earnings. So the stock price, drives further north. So you get appreciation in that stock price if you've got growth in your earnings. And corporations are going to have more earnings if they're paying less on corporate taxes and less on debt service. So fundamentals back to basics, that's kind of what the market is expecting. And that's why we're seeing that growth to the upside.
It's interesting. As much as you just said, don't time the market, if you were going to time the market, it's a pretty good opportunity to time the market between an election day and inauguration day. But I'm not disagreeing with you. I'm just kind of pointing out it is kind of interesting that.
Yeah, I mean, if you got in right before the week leading up to the election, there was a lot of volatility. But I think what we can also look at is divided government versus united government. So this is showing, you actually do have a little bit more growth in a united government when you've got united control. So 6 months before and after the elections, kind of looking at that, how that we're currently in a divided, we're moving to a united. So this is an interesting way of looking at this as well.
United government, to be clear, because it's like, half the people are really disappointed and half the people are really happy from the result of the election, right?
Correct. Another way of looking at this, so just, a couple different visuals here to look at 4-year returns post-election versus average 1-year rolling returns. If you had a united versus a divided, again, united tends to be, whether it be united government where all branches are Democrat versus all branches are Republican, you do tend to have positive returns. But I think the underlying theme here is the longer you're in the market, you're looking typically at positive returns if you're patient. So
another way of looking at this is if it's, a Republican win, it's not negative. If it's a Democrat win, it's not negative.
Yeah.
As in the United States, I mean, we're pretty savvy with the economy and running, with all our warts and bumps. I think we do a pretty good job collectively as a society to keep the economy growing and standards of living.
Correct. Yep.
Yeah.
So I think we're in a period where we can expect to see less volatility. I think we saw a lot of the volatility that we normally see in October. We saw that kind of in our August, September of this year. We saw a lot of that take place, but we did have a negative market leading up to the election. The week leading up to the election was fairly volatile. We had a drawdown in the market. But we're starting to see that uptick. We're starting to see less volatility per day. The VIX index, which is a measure of volatility and consumer sentiment with regards to volatility, we do tend to see that fall. So the 1 year after the election, after the presidential election, the first year of a presidential term, regardless of outcome, is typically less volatile. So we're starting to see that happen already. Okay, so what could we expect to see with the Republican Congress? And I think that, it's important to kind of go back to the note that you made, Jim, is that while we do have a Republican Congress and a Trump win, it is a very slim margin in the House. This isn't a wide margin. Now that there's a wider margin in the Senate, but there's not a wide margin in the House. But what we are expecting from a policy landscape is higher tariffs, an ease of fiscal policy. We're expecting the yields to stay a little bit higher, a little bit longer due to tariffs. So As we saw, we're going to also look at this in another graph here in a moment, but the short end of the yield curve, meaning short-term interest rates, are expected to be a little bit higher, a little bit longer, because there is an expectation of tariffs on other countries' goods. And so what we're looking at is this being strong for the equities market. The expectation is that this is still strong for gold. It's also done well for crypto, which is not on here, just a less regulatory environment. And we look at tax implications. We're looking at the cost of oil going down. We're looking at the tax rates going down. We're looking at gifting still being about the same. And we're looking at no change to the estate tax limits is what the expectation is. So we'll dig into this a little bit further.
It should be noted that, and I was reading about this morning, that the gift and estate tax laws that we have, the Tax Cuts and Jobs Act from 2017, that can be extended and avoid a filibuster, because I covered this in last week's webinar, the filibuster. It can be avoided in the filibuster through reconciliation, but it's capped at a 10-year extension. So, or if it's going to be renewed in whatever form, it would be renewed. I think all the smart kids are saying, the maximum term would be another 10 years. So it would not be a permanent, but 10 years is still a long time.
I get a mint, so I'm not coughing. I just ran out of water, and the sun is coming right through my window right at the wrong time in this webinar since the time change.
Because you're in sunny Southern California, Christine.
Sunny Southern California today. Right. Okay, so this is kind of what we're expected. Again, I think that there's a way to look at this is kind of, again, a split. It's close to a split in the house. So when we look at the returns, going back to what Jim said, there's no negative here. We're expected to see positive returns in the S&P 500. This would, again, fall in that we've got not divided. We're coming out of divided. We're going to united. United towards the Republican side tends to typically trail if it's united versus the Democrat side. But all in all, these things are positive. So I think that there's not a reason to have concern at this moment.
It's interesting that the single party control with Democrats, the stock market does a little bit better.
Yeah, historically speaking, that is true. Expectations with the Trump administration. So there's a lot here. So I kind of want to unpack this because these are kind of the expectations that we're seeing coming from all the multitude of experts, from, Goldman Sachs to JP Morgan, to all the tax experts, to all the estate planning councils. We're looking at combining all this data and going, okay, what is the expectation now with the outcome? And knowing we have a definitive outcome, what is the expectation with regards to tax policy? The expectation now that we do have that trifecta is probably not staying the same at a low corporate tax rate, certainly not an increase, but possibly even a reduction to 15% for corporations. So that's kind of the expectation at the moment in time. We're expecting to see a reduction of corporate for corporate taxes for U.S. producers and U.S. corporations. We're possibly going to see a reduction of individual income tax, and no more taxes on Social Security benefits federally. I know a lot of California residents, they don't pay, California does not tax Social Security benefits. Certain states do, certain states don't. But federally, there is still some taxation on Social Security benefits, depending on what income level you fall into. The expectation is no more taxes on Social Security benefits, and to remove tax on tip income and overtime pay. So that is another expectation with the outcome of the election. Federal Reserve policy. Now, this is one thing where I do think that the president should stay out of, having too much influence over the appointment of sure, but as far as like meddling in who's leading the Fed, that should be something that is a non-political entity. But it is uncertain as to whether or not Trump will keep Chairman Powell at the end of his 2026 term. So I don't expect there to be a change until 2026, but I do think that we're going to see a little bit more of a dovish pressure on the Fed, meaning that they're not going to be as aggressive in their rate cycle of reductions or hikes. So they're going to be a little bit more methodical. They were very hawkish in the fact that they were raising so quickly. They were very, very aggressive in the amount of rate hikes that they did because they waited a little too long post-COVID. However, I don't expect them to be cutting to zero or aggressively cutting. I think we're going to expect to see a little bit more of a pullback in the dot plot of how many expected rate cuts there's going to be. Right now, in the short term, we are expected to see a 25 basis point cut in December. That's the expectation of the market. But I don't think that we're going to see as aggressive of a downside in our interest rates on the federal funds rate because of tariffs. So if we are going to have tariffs, the expectation is that the Fed's not going to cut as aggressively. Now, I got to hand it to Trump, whether you like him or don't like him. In the first presidential term, he said he was going to implement tariffs, and everyone said that's going to cause inflation, and it didn't. So he was able to do tariffs in the first administration without having it impact inflation. Coming out of COVID, this is really where that we're unsure, is this going to make inflation stickier longer? So that's kind of why the Federal Reserve is expected to pause a bit and not cut interest rates too aggressively too quick. I think the last thing anyone wants coming out of COVID, the COVID era, is inflation to be rearing its ugly head again.
Yeah, I mean, the Fed actually did a great job. If you think about it, we have inflation is down, and we did not go through a recession. Everyone was talking for the last 3 or 4 years. All I've heard is recession, recession, recession. It never materialized.
Exactly. Now, from a fiscal policy, it is expected to have some reining in the government spending in certain areas, especially with the new creation of a Department of Efficiency that's not a government entity, but it's an oversight entity that will be run by Elon Musk and Vivek Ramaswamy. And so that'll be interesting with the mandate of cutting at least $2 trillion of spending. So I think that we're going to have a rein in government spending. I did hear I forget one of the news this morning, I think Wall Street Journal was talking about how Elon Musk and Vivek are going to run this reel, like a comedic reel of what will probably be funny and sad at the same time, of what the government waste is of things that we spend our money on. So it'll be interesting to see that highlighted and put public. That'll be an interesting thing, I'm sure. With regards to Social Security, Medicare benefits, that will probably be protected from any cuts. There's not an expectation. That's one of those things I hear a lot of from elderly clients that are either on Social Security or nearing Social Security. That becomes that third rail, that people do not want to cut any benefits for those that are, I'd say that magic number, the last time we saw a major change was under Obama in 2015. In December of 2015, we did see a major change. And the magic age that they don't touch is anyone that's already attained age 60 or above. Now, we're not anticipating any negative cuts towards Social Security or Medicare, but I would want to give that reassurance that age 60 is kind of that third rail. If you've already attained age 60, expect no changes. Could there be changes down the road if you're under age 60, someone like yourself and myself, Jim? I think we got to expect that our age is going to probably change as to when our full retirement age for benefits is.
Those boomers, they're getting all the benefits, and the Gen Xers and the millennials are stuck with the bill. Okay. All right. Next.
The extension of the Tax Cuts and Jobs Act. We're going to dig into that a little bit more, because I think that there's a likelihood that there will be an extension of the Tax Cuts and Jobs Act from 2017. However, it will probably likely look different, not quite as it is. So we're going to dig into that a bit more. A repeal of the Inflation Reduction Act is anticipated, and a return of the debt ceiling. So if any of you recall, they kind of postponed and kicked the can down the road and said, we're going to have no debt ceiling until we get through the election. So we currently are in a position where we have no ceiling on the debt limit for the government, and both sides of the aisle are guilty of just spending other people's money like drunken sailors. So I think that's one thing that the U.S. taxpayers are going to want to see, is some fiscal restraint. I don't know if we're going to see it from, again, both parties are guilty of this. So I'm not seeing a huge expectation of reduction in spending. I think the deficit is still a huge problem that will need to be addressed at some point for the future generations. But I do expect there to be a debt ceiling coming back after inauguration. And increased tariffs. The baseline assumption here is a 10% increase on Chinese goods. Baseline 10%, 60% on Chinese goods, and 100% tariff on cars produced outside of the US. So that is the expectation at this point in time. And a deregulated environment where there's less regulation in general will spur more mergers and acquisitions. I think Goldman Sachs said that they're expecting 20% more mergers and acquisitions over the next year.
I have a question on removing tax on overtime pay.
Mhm.
There has been an idea floated in the California legislature to reduce the work week essentially to 4 days. There's been talk of it on a federal level to reduce the work week to 4 days, which would be a 32-hour work week. Have you heard anything about reducing the work week to 32 hours coupled with, because effectively you could say you work 4 days, your fifth day is overtime, and then there's no tax on the overtime, which is kind of, I just wonder if contractually, uh,
Yeah, this is one of the arguments that from a fiscal conservative standpoint, the there's always going to be a way to manipulate the system is like if you all of a sudden classify more of your wages as tips, then those aren't taxed. So it just changes the way things do it because there's always a game of tax avoidance. So I think it'll be interesting to see how that all plays out. Combined corporate versus pass-through entity taxes. This is a lot of business owners that are S corps decided to pay their taxes through their pass-through entities due to the SALT caps and limitations of being able to deduct your state income tax on your federal return. That will probably likely be advantageous for S corp or pass-through entity business owners. So we do expect to see that continue. And this is kind of the top expected rates. With the new 25 tax bill, the expectation is that 37% will remain the high tax cap for individuals, and we'll expect to see that corporate rate come down from what is currently 21 down to 15 is the expectation.
yeah. So what we're talking about here is when you own a business that's not a lawyer, a CPA, a financial advisor. I think architects are included, no, I mean, or excluded from that list. Essentially, if you're a business owner, you get to deduct 20% of your income. So it's actually more than a 20% savings on your tax because we have a graduated tax system. But basically, the idea is the Tax Cuts and Jobs Act of 2017 rewarded people for taking the risk of having a business and effectively penalized people if you're a W-2. If you're just I don't want to say just a W-2, but if you're a W-2 earner who has no business income on their individual income tax return. That's what we're talking about. That was set to sunset or is set to sunset in 2025 unless it's extended. But it's a method to encourage people to be in business, right? To create a small business, if you will, and to get a 20% deduction, which results in a tax savings typically of more than 20% of your tax bill. So very, very important. And this is, this has been around for a while. Most people know about it, but for those of you who may not know about it, I will tell you, we have a saying at our firm. Basically, the W-2 people are getting screwed, for lack of a better term. You are paying the highest taxes. You have very limited deductions. And the people who are in business have a lot more leeway to pay less tax. So if you're on the fence about being a W-2 earner or being in business, there are a lot of benefits to both. There's a lot of downsides to both, but there is a significant tax benefit that looks like it'll be extended for another 10 years. This sort of this deduction for a qualified deduction for business income.
Yep. And I think we do expect to see an increase in the standard deduction and the SALT cap. So the 7 current tax brackets will likely increase. I would expect that the standard deduction is increased. The state and local, which we've referred to as SALT cap, the SALT deduction, is expected to increase. I've heard, 20, 25,000. I don't think that we know what the number is exactly at this point in time. However, kind of jumping to that point number 3, as it relates to SALT, is the AMT tax, which it affects very few people. I mean, until they raised the bar, I think it's not until, at least at the federal level, states different, but at the federal level, I want to say it's a little over 1 million right now. I think it might even 1.2 million. You'd have to hit that threshold of W-2 income or taxable income to then have an AMT tax. And so what we'll probably see is the AMT cap come down in order to accommodate for an increase in the SALT.
Yeah, what AMT is, alternative minimum taxes. There, you have income and you have deductions on your 1040, your individual income tax return. If you have a whole bunch of deductions that essentially wipe out your income, the idea is the government says you can't really do that. There's a minimum amount of income. You got to pay some tax. Unfortunately, the AMT brackets were not adjusted for inflation, and this is going back like 50 years. So that is the central problem is, stuff's way more expensive than it was 50 years ago. And this AMT threshold hasn't increased. So that
Correct.
may be coming back, may not, that it is going to play into it. But I will tell you, if you live in California and and you recently bought a home and you pay state income tax, the amount of tax that you're paying in property taxes and state income tax is well beyond $10,000. So any increase is beneficial. But it used to be that you would fully deduct your you would deduct from your federal income the amount of state income tax or property tax that you paid. And what they're talking about is expanding that. So that's really what's going on.
Right. And then we're expected to see the child tax credit get extended to at least to the like what would support the adjusted for inflation, post-pandemic era. I think that is something that they're trying to bring the inflation rates to these. To your point, they haven't been adjusted for inflation for a while. And 199A for QBI, that is really something that applies to the pass-through entity owners as well as real estate passive business, is that tax rate is at the lower rate. And so we do expect to see that as it goes from 21 to 15 for corporations. They'll probably also work on the section 199A QBI deduction. And the gift and estate tax exemption is likely to remain unchanged. So I think that is probably going to stay at, it's currently 13.99, Jim, million per
Yeah, I
person.
don't know why they didn't round 13.99 2025. I don't know why they didn't round up. It's 14 million. But if you're single and you're above 14 million in net worth, or you're married and above 28 million, you got to do something at some point. So, it's not like this intense pressure is on, but in order for these tax or I got to say this the right way, in order to take advantage of all of the benefits to reducing the taxation of wealth from one generation to the next, the general rule is the longer the better. So the longer, if you start 5 years before death, you're not going to get as much benefit as if you start 40 years before death, right? So
Mhm.
the idea is you want to start really a long time before you're passing. If the wealth transfers by death, you would want to start that process significantly earlier. I do want to mention one thing here. When we talk about corporate tax, there are two types of corporations. There are corporations like Apple that when they pay tax, it is paid from Apple, the company, and they pay their tax. And then when you receive an Apple dividend, you have to pay a tax on that dividend. That's the type of corporate tax we're talking about. We are not talking about your S corp. If you have a business and you have a corporation that has classified as subchapter S, or you have an LLC that is classified as a subchapter S corporation, there is no corporate tax. That's all put on your individual return. So what we're talking about here is what we call subchapter C corporations, and that's that 15 or 21% taxation. We do cover that in other webinars on our YouTube page.
Yeah. And while I know that seems like it's coming down and it's like, oh my gosh, these corporations, the rates are coming down, it's actually falling in line with more globally accepted corporate tax rates. I think Canada is at 15, but most of the global developed world is between 15 and 20. And
By the
so
way,
this,
yeah, there's also state income tax on top of that. So Apple
correct.
does pay California state income tax. So state income tax 13.3%. So go
Yep.
figure.
And if the corporations have more money to put towards their earnings, again, that drives the stock prices up. So I think all these things bode well for the stock market. Now, when we're looking at just kind of a different way of looking at the breakdown, the likelihood of change to the individual tax rates is low. Now, I know this is saying low likelihood of change to the standard deduction. I think that we'll see that go up. I do think that we'll see some at least adjustment for inflation there. The expectation is low that we'll have any change to the current estate tax limits and the clean energy credits. I think that's a mixed bag. We're not quite sure how that will look as far as coming out of this. When you've got people like Elon Musk and Robert F. Kennedy in the administration that are also going to balance out some of the Trump agenda with regards to the clean energy credits and tax credits. I think it'll be interesting to see how that comes out. So I think that's a mixed bag there as to what we don't have any real definitive expectations. When it comes to income taxes, pre and post Tax Cuts and Jobs Act, the majority of Americans are going to be paying less taxes. And this is kind of that average effective rate. So even though that top tier individual rate is 37%, we're seeing this, overall across the board is that we're probably going to see people pay about 1% less in taxes.
Now, if you're looking at this going, I pay way more in taxes than that. If you live in California, you got to add state income tax. And
Yep.
for planning, we typically add about 10%, something like
Yep.
that,
Yep.
depending on.
At least 10%, depending on where you fall in California. Now, yields. This is kind of where I was mentioning that we have seen a push higher post-election. So in the yield, short end of the curve, meaning those short-term interest rates, they were coming down. We have seen them come up a bit. So the dot plot, I think, has been the most watched thing over the last 3 years as to what is the Fed going to do with interest rates. The dot plot is the expectation of where rates are going, where the puck is going. And they have been wrong for a long time. I think a lot of analysts have been wrong as to where they think. I think the dot plot has been adjusted every single month for the last 3 years, and it's been way off. I mean, we entered this year with 6 expected rate cuts. So, I think we're going to end up with what, 3, maybe 4. We did 50 basis points at the first one. We did 25. We might get another 25.
But look where it's not going. It is not going down.
No.
It's not going down low enough to get that 2.75% mortgage again. And by the
No.
way, that is not something I think a rational person would want to wish for, because that either means there's a pandemic, a massive depression, something really bad is happening when interest rates go that low. Okay, that's like crisis, right? So another thing too is on banking stocks. I was speaking with a banker this morning. I was at a business meeting, and she pointed out that when you're getting nothing on your bank deposit and it jumps to 5%, that is a liability for the bank. So the bank has to pay, right? They've got to pay the interest on your money that's sitting in your bank account. Banks really haven't been lending a whole lot for the last couple of years. There's an expectation, and so their profits have really kind of gone down for a lot of banks. Banks are going to start lending a lot more aggressively next year. So, we could see mortgage rates come down if the banks increase their lending, but they've really been cagey on lending lately. So the mortgage rate, it's interesting that it's kind of decoupled from, typically when more interest rates go down, mortgage rates go down, but they haven't. And I think this is the answer, is we've seen this increase in the 10-year treasury, which a lot of mortgages are pegged to, is that 10-year treasury.
Correct. It's pegged more to the 10-year treasury yield. So if you're looking at where rates are going, it's really there. So what I want to kind of dive into too is what the expectation is with the market, really. And a lot of it goes back to fundamentals. Do politics have an impact? Does fiscal policy have an impact? Absolutely. But at the end of the day, there's fundamentals that I want to kind of get back to focusing on as to what does this mean for the market right now? And as the earnings yield has been low, the earnings yield has been lower than just the treasury yield. So it's been making stocks look too expensive. So I want to put this in perspective, and we're going to spend a few minutes breaking this down. But what has been more expensive on the price earnings ratio for the S&P 500, which is simply a number, it's just a division of the price divided by the earnings. And the current S&P 500 PE is about 26. And so that has been deemed as to be expensive. And so is the market overvalued? Let's break that down, because I think that interest rates play a significant role in where the treasury yields are going. So even though we don't expect rates to come down aggressively, they're still coming down from this all-time 40-year high. And so let's break this down a bit more. If we go to the next couple slides here, Jim, we're going to get into some calculations and math stuff, but this is also just reminding us where we are with regards to the secular bulls, secular bears. We are in a secular bull market.
What is a secular bull market? Because secular to me is like not church, but what is a secular bull market?
Secular is long-term trends. So you might have short-term, like, 2022 was a short-term cyclical trend where the stock market pulled back aggressively, but that was really due to the delay of the COVID effect. the rate hikes and the aggressive rate hike cycle, and we weren't in a recession. So it was just a stock market cyclical downturn that was short-term in duration. So these are more long-term trends. We're still in a long-term secular bull market, and we still feel like there's room to run. And so getting into the math of the why, let's break down where we have been, which is at all-time highs. Yes, but we can remain at all-time highs for a long time. And I think this next slide gets into the where we are currently. So yes,
Ooh, this is a lot of math.
this
Hey,
is a lot of math. I'm going to make it simple here. And
you can ask
this
any
is
lawyer, you ask any personal injury lawyer, divide any number by 3, and magically they can give it like to the decimal. But okay,
two plus two
that's what they're
equals
feeding.
four. We can all do some simple math here, but essentially what I wanted to look at, we hear about PE, and I think that that is overly looked at. Again, it's just a division equation. That's all it is. It doesn't have a ton of meaning until you put context to it. And so if we look at the current PE ratio of the S&P 500 being at 26, when you correlate that to a 90-day, 3-month treasury bill, if a 3-month treasury bill is paying 4.63%, not taxed at the state level, by the way, only federally taxable, that's a much better rate than sitting in a money market or a CD. So if I can sit down and just collect 4.6% for the next 3 months, why take the risk in the S&P 500 when I'm going to earn more on the earnings sitting in a 90-day treasury? So that's where the historical valuation ratio equates to 0.83. Looking that in translation to on this next slide, how does that fare with regards to, is that overvalued, undervalued? Well, a 0.83 historical valuation would, on that ratio, would lead you to believe we're a little overvalued right now. You know, are we a little, is it time to take profits off the table? Maybe, but we also then have to take into context what's happening with interest rates. So if we take a look at this next slide, okay, well, rates are coming down. We're going to probably be approaching that 90-day Treasury T-bill of 2.4%. Interest rates matter. So if we go to a historical valuation ratio of 1.6, where we're going to earn more being in equities, and if we have inflation that is a bit stickier longer, to get better than inflationary returns, you're going to have to take some risk in the equity market for your long-term growth of your portfolio. And this would translate into an undervalued valuation on the S&P 500.
Okay, so let me stop you here because as I'm listening to you, I think if somebody might think, well, the stocks will go up when those interest rates come down. So interest rates go down, stocks go up. But isn't the stock market predictive? They're thinking 6 months from now, right? So all these people who are involved in the stock market, they're not thinking November of 2024. They're thinking of May 2025, right? That's really what they're thinking about.
Yep. Yep. So with all of these things with, corporate tax reduction, some of the things that are going to come out of fiscal policy from what the market has certainty coming out of the election, they do matter. But the underlying trend is also, if all those things translate to earnings and lower interest rates translates to a better, historical value ratio, this is going to make stocks very attractive with giving them more room to run. So this is the question is, will history rhyme? And if it does, the expectation is that we could have 60,000 on the Dow by the end of 2026. Now, that will be the question mark that you asked in the beginning. Don't we wish we had a crystal ball? I don't know. But this is what we're looking at when we break down the math. And this is what we're looking at, the equities market still being very attractive, still having a lot of room to run.
Wow. You know what? I'm going to go back to something here, Christina. Right now, the 90-day T-bill's 4.63%.
Roughly. I think it's come down just slightly since this was done in
Yeah,
September.
right. So we're doing this now, but it's still pretty. I mean, it's kind of what you would get in a bank account, right? Like a savings account.
But at least in a treasury, you're not getting the state tax.
That's what I want to, that's where I want to go with that is you're not taxed. And this kind of this goes back to like financial planning, right? Is if you can have money in something that's not generating a state income tax bill. I mean, if you have $100,000 in there, you're going to be saving, I don't know, $400 in tax or something. Okay, you can fill up your car maybe 3 or 4 times for that $400, but still money's money, right? That makes sense.
Exactly. So I know that this is a lot of math, but I think hopefully that makes sense to help people understand, gosh, just because the PE is what it is, it has not a lot of bearing when you put it in context. So I definitely wanted to spend some time on that because I think that we can get caught up in the emotions or the emotions of the outcome of the election. And you got to be very fundamental and put emotions aside when you're looking at your investment portfolio. And the other thing that we're looking at is the recession dashboard. As far as this comes out from looking at the 9 different factors of leading economic indicators from the US Conference Board. And what is the recession dashboard showing is a lot less risk of a recession right now. So the overall signal is even from March of this year, we were still in that, is the Fed going to get a soft landing? What's going to happen? We were in that yellow overall signal, caution. We're in the growth on not seeing a recession indicator right now. So I think this is also important because we've heard, like you said, 3 years now, there's been this recession. I mean,
Ooh, recession's coming.
exactly. And you know what? Recessions are going to happen. They are normal. You have to prune the rose bushes for them to grow again. But right now, we're not seeing a shoe to drop that's indicating a recessionary risk. And if we go back light on that slide on the recession dashboard for a moment, is actually since this was done on October 31st, we've seen the ISM manufacturing orders come out. Because of the outcome of the election, there's an expectation of more manufacturing domestic and an expansion in middle America manufacturing. The ISM new orders manufacturing has actually come up to it's a 56 now, I believe, on the new ISM orders. So even that has come from an X recessionary indicator for manufacturing to positive. So
So it's interesting with the election. Now, this may have been a function of it being a Veterans Day holiday. I went to the Nordstrom in Corte Madera, which is in Marin County. Before the election, just before the election, there was nobody in the parking lot. I went back in Sunday after the election. I couldn't even find a parking spot. It was crazy. The stores were full of people buying stuff. It's like everyone was watching the news or they're listening to their podcast or looking at their Twitter feed or whatever. And like, the election. And then it happened. And,
yeah.
it's almost like things are never as bad as they seem or never as good as they seem, right? I think there's fear in there's so much fear. Anyway,
Yep, the pendulum always swings a bit. And this brings us back to our conclusion, really, is that election outcomes do not drive market outcomes over the long run. And so fiscal policy certainly impacts some things. However, you can make money under any administration if you have a plan and you have some discipline and you stick to fundamentals. It kind of goes back to my saying, I've said this before, if you chose not to invest under Clinton, you lost money. If you chose not to invest under Bush, you lost money. If you chose not to invest under Obama, you lost money. If you chose not to invest under Trump or Biden, you missed out. So this is one of the things where staying disciplined, not letting emotions drive your investment decisions. We're not in a recessionary indication right now. This is still a positive market to be participating in the equities market. And actually, probably as interest rates do come down and you're just getting the inflation rate of return, it's time to deploy some of those cash assets into some other things right now. And so this is just a reminder of, regardless of your feeling on the outcome of the election, whether it be positive or negative, it's still time to have a disciplined approach when it comes to your financial portfolio.
all right, this is our contact information, how to contact Ascent. They've got Southern California, Auburn, Sacramento area, as well as the Bay Area. By the way, there are two Bay Areas in California. There are two South Bays in California, right? There's the South
Yes.
Bay Torrance and South Bay of San Jose. But when we say Bay Area, we're talking to the San Francisco Bay Area, as well as Westlake, as well as Westlake Village. So next, as if you're watching this on YouTube, please subscribe to our YouTube channel. And why you shouldn't add your child to the title to your house is our next live webinar, December 12th. We're going to take a little bit of a hiatus through, I've got a conference I'm speaking at as well as Thanksgiving, and we'll be back December 12th. And we'll be releasing other videos on YouTube that I will be doing in a non-live setting. But Christina, I wanted to thank you for joining us here today. And what I'm going to do is we're going to open it up for questions now. If you're watching this on YouTube, just keep watching, because magically another webinar is just going to start right after this one. So thanks for joining us. And please make sure and put your comment in the comment field on our YouTube page. Thanks.